All right, let's talk about something every trader runs into. You open up a chart and it's just chaos. You see dozens of potential order blocks and you're left completely paralyzed. Well, today we're going to fix that. We're moving beyond just finding these levels. We're going to learn how to spot the ones that truly matter, the ones with the real power to reverse the market.
So here's our game plan. We'll kick things off with what I call the order block dilemma. Then we'll dive deep into the anatomy of a powerful level. After that, we'll build a simple checklist to grade these levels, talk about why context is everything, and then wrap it all up with how to get that final confirmation before you pull the trigger. First up, the order block dilemma. This is all about that feeling of being totally overwhelmed by too many options on the chart, leading to that dreaded analysis paralysis. And this is the million-dollar question, isn't it? When there's so much noise, how do you filter it all out? How do you focus only on the signals that smart money is actually paying attention to? I absolutely love this analogy from the source material because it's perfect for trading. Your chart is littered with gold. These are the obvious, decent-looking levels that everyone sees. But the real prize, the diamond, is often that deeper, more powerful level that most people just completely miss. Our job is to become experts at spotting those diamonds. Okay, so if we're going to separate the gold from the diamonds, we need a framework. So let's start by breaking down the anatomy of a truly powerful level. What are the key ingredients that give it its strength? Let's start with the basics. An order block is really just a zone of concentrated liquidity. Think of it like a fuel station on the highway of your chart. Price is constantly drawn to these fuel stations to power its next big move. And just remember, the higher the time frame, the bigger the fuel tank, and the more explosive the potential reaction. And this is where it gets really interesting, the hidden order block. You see, when price moves really fast, it can leave behind an inefficiency, a gap. We call this a fair value gap, or FVG. And this gap can literally hide the original order block from view. Trading algorithms are specifically designed to go back and fill these gaps, which makes these hidden levels incredibly potent reversal points. The more hidden it is, the more powerful it becomes. So, every time you spot a level, you need to run it through this mental checklist. Is it on a high time frame? Check. Is it untouched, meaning it's got all that fresh liquidity? Check. Is it hidden behind one or more of those FVGs? Are multiple time frames all pointing to the same area? Can we refine it for a better entry? Are we trading a high-volume asset like Bitcoin or ETH? And finally, does it line up with other tools like fibs or market structure? The more yeses you can tick off, the stronger your level. All right, let's take all those factors and turn them into a super practical checklist, a system you can use to grade any level you find right on your chart. And this, right here, is the absolute core of what we're talking about today. Not all order blocks are created equal. There is a very clear hierarchy of power, and learning to see it is what separates the pros from the rest. It's a total game changer. Here's what that hierarchy looks like in action. At the very top, you have your optimal levels. These are the best of the best. Untouched, hidden, high time frame blocks that are confirmed across multiple stacked time frames. Just below that, you have semi-optimal levels. These are still really strong, but maybe they're missing that extra layer of confirmation from other time frames. And then at the bottom, you have the lower quality stuff. A single time frame block or one that's already been tapped. Yeah, they can work sometimes, but the probability is just so much lower. So when you're looking at a chart, here's how it plays out. You start broad. You might spot a big zone of interest on a high time frame, maybe the 12-hour. You confirm it's untouched. That's absolutely critical. And from there, the next question is always, can I zoom in? Can I pinpoint this even further? That's the thought process. So what is this refinement we keep talking about? Well, it's just the process of drilling down. You find that big general zone on the 12-hour chart. Then you click down to the 8-hour, then the 6-hour, and you're looking for the most precise point of interest inside that bigger area. And the result? A much, much tighter stop loss, which just massively boosts your potential profit. And this is where the magic happens. Look at this. On the left, a trade on that raw 12-hour block might need a 7% stop loss. That's a huge risk. But by refining it down to a razor-sharp 6-hour level on the right, that stop shrinks to under 2%. You literally cut your risk by more than 2/3, which sends your potential reward through the roof. This is how you get those incredible risk-to-reward trades. Okay, so we know how to find a powerful level. But listen, a great level in a bad location is totally useless. That's why context is, and always will be, king. location, location, location.
Here's a super simple but incredibly powerful way to think about context. Just draw a Fibonacci tool from a recent range high to the range low. Anything above that 50% line is considered a premium price. That's a good place to start looking for shorts. And anything below it is a discount, an amazing place to hunt for longs. Trust me, a perfect bullish order block in a discount zone is infinitely more powerful. And this quote just brings it all back down to earth, doesn't it? We're not looking for some crazy to-the-moon trade. No, we are identifying a defined range. We're looking to buy at a discount at the bottom and sell at a premium at the top. It's disciplined, it's repeatable, it's a business. And here's another critical layer of context. Always check the majors. An amazing setup on some altcoin becomes 10 times stronger if you look over and see that Bitcoin is approaching its own key high time frame level at the same time. Think of the majors as the wind at your back. They provide that tailwind that can turn a good trade into a great one. So you did it. You found an optimal level. It's in the perfect context. Now for the final piece of the puzzle. How do you actually get into the trade? And listen up, because this is so important. Wicks are liars. They're designed to hunt liquidity and shake you out. What you care about are the candle bodies. A body closing above your level for a long or below it for a short, that shows real market conviction. That is the true acceptance or rejection you've been patiently waiting for.
So once you get that beautiful confirmation close, you've basically got two choices. You can jump in immediately, which guarantees you're in the move, but you might not get the absolute best price. Or you can be patient and wait for a retest of your level. This offers a way better risk to reward, but it comes with the painful risk that price just takes off without you. There's no single right answer here. It's a strategic trade-off you have to decide on.
Okay, we have covered a ton of ground. So let's boil this entire process down into one simple, actionable framework you can use starting today. Here it is, the entire system in 5 simple steps. 1. Find your high time frame level. 2. Assess its quality with our checklist. Is it optimal? 3. Confirm the market context is on your side. 4. Wait patiently for that confirmation candle close. And finally, number 5, execute with your plan. Find, assess, confirm, wait, execute. That is your new repeatable process. So there you have it, a complete framework for cutting through all the noise and focusing only on the highest probability levels on your chart. Remember, the goal isn't to trade more, it's to trade better. Now you have the tools to tell the difference between the gold and the diamonds. The only question left is, which ones are you going to choose?